You might believe that $500 is insufficient to start investing, but in reality, every great wealth has a humble beginning. By spending your first $500, you'll begin understanding ideal investment principles to adopt, and over time, the potential of compound growth may allow that modest initial money to grow significantly. Fortunately, this video will guide you on the 5 vital strategies to get you started if you have $500 set aside for an investment. Passive income. Since it involves minimal effort to generate income, passive income continues to be appealing.
Charlie? Well, when you found Ben Graham, he was unconventional, and he was very smart. And, of course, that was very attractive to you. And then when you found out it worked and you could make a lot of money while sitting on your ass, of course, you were an instant convert. And so...
It still appeals to me, actually. I mean...
Therefore, consider using your $500 capital to work for you by doing this. One of the best ways to make passive income is to start a business that requires labor up front but lets you work less as it grows. It should also generate interest or dividend income and increases in value over time. Munger emphasizes the need to be patient, since failing to give your investments adequate time to flourish is one of the most typical investing errors. Some of the ideal ventures to consider with a $500 capital are affiliate advertising. In this venture, you'll receive a commission to market someone else's good or service. When you sell other people's stuff, you don't have to put any effort into it. Fractional investment. Internet businesses are radically changing conventional means of investment and enabling consumers to invest in fractions, which is more economical. Crowdsourcing and property investment in stocks reduces the cost of investing. Hence, it is possible to invest in profitable ventures using your limited funds. Bottom line, making your money work for you is a smart approach to earning a profit passively. It gives you more time to pursue active income and is a great way to preserve your possessions' worth. Save more when the market is not favorable for investing. Success is rarely linked with doing nothing. Most people think it compromises researching investments, identifying and monitoring them, searching for new ones, sorting out the old ones, and so forth. That's a lot to keep track of, and when markets perform significantly below expectations, investors frequently feel pressured to take action, like exiting the market or increasing their holdings. Often the most effective option is to choose to take no action. Munger believes that if you're not patient and can wait out, your portfolio will benefit significantly, despite what may appear contradictory, considering the rapidly declining market values. Fortunately, increasing your savings from $500 to $1,000 monthly is easy without making any major adjustments.
And I don't say that it's always better to be saving 10% of your income instead of 5% of your income. I think it's crazy to be spending 105% of your income, and I think that leads to all kinds of problems, and I get letters from people every day that have experienced those problems. In the end, if you want to have an internal scorecard.
You can accomplish this objective by adopting these 3 saving strategies. Create a budget. I'm sure you've heard this strategy plenty of times by now, but it's vital to note that although it may seem cliché, setting up a spending plan is crucial in learning how to save money. Putting some of your money into a savings account will be easy if you know where it's going. Hence, if you don't already have one, think about starting with this action. There are other well-liked budgeting techniques, including the 50-30-20 approach. This method allocates 50% of your income to needs, 30% to pleasures, and 20% to savings. However, the distinction between necessities and wants is getting increasingly blurry. For example, some services may seem necessary, but is that the case? See what happens if you try going 1 month without one. You probably have a want rather than a need if the disparity is slight or non-existent. Comparing prices when purchasing insurance. Due to the complexity of insurance, your premium at one insurer may differ significantly from your premium at another. Therefore, getting quotations from different firms is vital rather than updating your insurance each time it is due. Determining if switching will save you money should take a few minutes, thanks to the accessibility of insurance comparison websites. Automate your savings. You can configure automatic monthly deposits for savings accounts in many instances. It is convenient, but it can also make it simpler for you to accomplish your objective. Online savings accounts allow you to deposit exactly the amount you desire each month. Thus, this applies to all income levels. How to invest the saved money. Purchasing stocks may seem to value at a high price below their actual or net worth is known as value investing.
We gradually morphed into trying to buy the better companies when they were underpriced instead of the lousy companies when they were underpriced. And of course, that worked pretty well for us.
Stocks underestimated by the industry are actively sought after by value investors. They argue that the marketplace reacts to both positive and negative news, causing fluctuations in stock prices that are inconsistent with a company's fundamentals over the long run. According to Munger, the market's reaction offers a chance to profit by obtaining a bargain on stocks. Most people know that buying stock also means purchasing a stake in the company. As a result, Munger advises choosing your stocks wisely and treating them like your own firm. While you monitor the company's performance, refrain from withdrawing money too quickly. You should only invest in yourself using funds you are willing to commit to for at least the next 5 years. The most excellent strategy to maximize your gains is to focus on the long run, particularly during times of volatility. Gold bond investment. Given that they combine the advantages of gold holdings with the fixed income component of a banking fixed deposit, gold sovereignty bonds, SGB, are among the most excellent investment options. The main principle of wealth creation is to gain more while losing less. As a result, even when gold prices fall, the value continues to rise. Gold has recently maintained stable pricing and has become a haven asset during market downturns. You receive fixed interest and the benefit of rising prices when gold prices eventually rise. You stand to acquire a significantly larger sum of money from gold securities than other investments when you invest your money for the long term. Index funds. An excellent option for a beginner investor to explore the extensive stock market is through index funds. The S&P 500 is one of the most well-known indexes. It includes some of the biggest and most prominent corporations in the world, including Facebook, Tesla, Apple, Microsoft, and others.
I mean, you can't really fail at it unless you buy the wrong stock or just get excited at the wrong time. But if you own a cross-section of America and you put your money in consistently over the years, there's no comparison against owning something that's going to produce nothing.
However, before investing in this category, it's essential to note that the right-hand man of Warren Buffett, Charlie Munger, a Berkshire Hathaway executive, recently voiced his concerns about the state of the markets. He made a sobering future prediction that investors shouldn't overlook. To safeguard themselves, investors should review their portfolios if they are concerned about a financial collapse or believe that equities are too expensive. Investors should consider purchasing shares of a reputable healthcare stock like Johnson & Johnson, J&J, rather than Amazon at a P/E ratio of over 70. It is a much more affordable investment at a P/E of 28, and the company is very strong. It checks off every essential box that value-conscious investors could be searching for. It also has continuously generated profits, and just once during the previous 5 years did its net margin drop below 17%. Johnson & Johnson still has growth potential, even though its revenues of $82.6 billion for 2020 were marginally higher than its $82.1 billion total for 2019. Moreover, Johnson & Johnson Inc. is a dividend lord, with dividend increases going back over 50 years. The most recent addition was in mid-2020, when it increased its repayments by 6.3%. Now, shareholders receive $1.01 in quarterly dividends from the corporation for each share they own, yielding 2.6%. Avoid saving the entire amount. Savings accounts are the best way to safeguard your money. In this approach, you will always have accessibility to it and won't need to be concerned about your principal deposit depreciating. While having some financial security in cases of crisis is beneficial, you should avoid depositing all your funds in savings accounts.
There are plenty of people that I don't advise to save. I mean, if you're struggling along and making a reasonable income and you have a job with a 401k being put aside for you and you have Social Security, who's to say whether it's better to defer $1 of expenditure on your family on a trip to Disneyland or something that they'll get enormous enjoyment out of, so that when you're 75, you can have a 30-foot boat instead of a 20-foot boat.
Even if interest rates were higher than they are right now, they might not even come close to matching the gains you can get from investing in a trading account. Contrarily, there is danger involved with investing. Yet, if you're willing to take that risk, you can increase your return on investment above what a savings account offers. Save funds for short-term objectives like a car, house purchase, or emergencies in a savings account. But investing your money could be much more a profitable option if you're trying to save it for long-term objectives such as retirement. You can trade in exchange-traded funds instead of investing in stocks if you find it difficult or need more information. They allow you to invest in the overall market without assuming the risk of buying specific companies, and it can increase your comfort with the concept of investing altogether. Compound profits. The rate of return on a deposit is known as compound interest because it is computed using both the original principal and the interest accrued throughout prior periods. Interest can be compounded daily, monthly, or yearly, among other frequency plans. During our lifetimes, you can still benefit from the potential of exponential growth, especially when reinvesting our earnings to maximize capital. Given the present economic situation, investors must consider all options that will enable them to meet their future investment goals. Therefore, maximizing and ensuring you are already on track to achieve your long-term financial objectives in 10 to 20 years is essential. One of the best approaches to benefit from compound interest is by making 401k contributions. With a 401k plan, you can save an amount of cash that grows tax-free up until the time of withdrawal at retirement, at which point it is subject to ordinary income tax. It implies that if overall contributions were $500 and the tax rate was 30%, just $350, or the remaining 70% would be left in the account. By the time you reach retirement age, this money would have grown to a sizable sum if it were well invested, earning compound interest and dividend over the years. The significance of retirement savings cannot be emphasized enough. If you don't, you can run into serious money problems in your older years due to a lack of resources. Consider it in the form of a snowball. The more money you put into your snowball and the earlier you start saving, the bigger it will get. Imagine now that you've rolled the ball down a snow-covered slope. The snow you have packed will remain, and it will continue gathering snow. At the bottom of the hill, your snowball will eventually include the original snow you started with and the additional snow gathered during its journey. The realm of investing can be both fascinating and dangerous, a two-edged sword. Therefore, before investing, it is advisable to get the advice of a financial counselor.
I think that if you run into a few great teachers and they really change the way you see the world to some degree, you're lucky, and you can find them in academia, and you can find them in ordinary life. And I've been extraordinarily lucky in having great teachers, including Charlie. I mean, Charlie's been a wonderful teacher.
If you have a gut feeling about a specific investment, follow that instinct. Additionally, regularly monitoring your investment is also recommended. Even if you don't watch your portfolio weekly or monthly, it is crucial to thoroughly review your investments at least once every 6 months or once a year to enable you to assess their performance. If you feel this video has greatly assisted you in making wise investment decisions, kindly like it and subscribe to my channel. It would be best if you also hit the notification bell to be alerted as soon as I upload another video. I'll continue to share more valuable financial information and advice from reputable global investors to enable you to attain your financial objectives in 2023.